FY22 Hotel Tech Awards organized by Hotel Tech Report, where over 1,000 tech product companies compete to take home the top honors. In Hotel Tech Awards, the most competitive year yet, Rategain continued to maintain the number one position on social media with BCV, while our Rate Parity product Parity Plus and Rate Intelligence product Optima finished as first runners-up in their respective categories. Rategain's channel manager Rategain ended up as the second runner-up in one of the most competitive product categories in the competition. So let me start by giving you an introduction to Rategain. So for those who have recently discovered us and would like to get an idea of who we are and what is Rategain about. So basically, we provide SaaS solutions to travel and hospitality industry. Rategain's vision is to be the leading revenue maximization operating system, which offers an integrated tech stack that enables the travel industry to accelerate their revenue through acquisition, retention, and wallet share expansion. Our customers include the top 23 out of the top 30 hotel chains, the top 25 out of the top 30 OTAs, all the leading car rental companies and cruise lines. So pretty much all the leading suppliers and intermediaries in the travel ecosystem are Rategain customers. Our business works across three major segments that our customers need. Data as a service that really provides competitive insights around pricing, around travel demand, and now we also launched a new product called RevAI that's an end-to-end pricing platform. Our second business line is distribution that basically provides connectivity to hoteliers to get travel demand from OTAs and GDSs. Our third business line is MarTech, which is an end-to-end digital marketing platform to digitally acquire customers, elevate brand equity through brand education, awareness, and engagement. Let me now give you a sense on how the industry is faring. So from an industry standpoint, while the impact of COVID was felt the hardest in the sector of travel and hospitality, up until December, we had been seeing green shoots over the past couple of quarters, and revenge travel was quite evident as per our numbers as well. As Omicron was hit, we did see some pause in December and January, but we began to see things look up again. As you might have seen also in the news, quite a few countries are doing away with the requirement of pre-departure COVID tests, as most experts are suggesting that we are now moving into the endemic stage. Even though we also saw some pause in travel bookings in months of December and January, we are seeing demand rise again. And if you look at our product demand AI, we are already witnessing a 10 to 14% increase in demand in February in key cities like New York, London, Barcelona, Delhi, as international travel takes center stage. And this will only further improve as we approach spring. This makes us believe that the travel industry is set to rebound in 2022 and witness a CAGR of 26% by calendar year 25 as per premier research from Focusrite. With multiple options of vaccine, booster doses, and over-the-counter medication available, governments and private individuals are better prepared to tackle COVID-19. We're confident that these factors will help in lesser disruptions in travel and sustainability and substantially impact demand in a positive way. As most experts predict, the rebound would largely be driven by leisure travel, which constitutes 96% of Rategain's business and is a core focus for driving our MarTech business. While the industry is bouncing back, I also want to talk about some structural shifts that are happening in the industry. So, there is clearly an acceleration of digitization and automation, just like other industries. Hospitality and travel is seeing much larger adoption of technology. Secondly, especially in Western economies, there is a massive shortage of labor in this industry. A great resignation trend that is talked about has hit hospitality and travel industry, especially in the US. So we believe that Rategain is going to be a big beneficiary of these structural shifts in the industry. So now let me comment on each of our business lines and, talk about how we performed last quarter and 9 months. So in MarTech business, most of the growth has been driven by our MarTech business, which now contributes to 34% of our overall revenue, which is 110% growth when compared to the previous fiscal and witnessed higher new bookings than even pre-pandemic levels. The business increased its number of properties by 65% and has 99.9% recurring revenue. This continues to be a strategic growth driver, and we continue to be bullish as we move towards the next fiscal year. Our acquisition of MHS, My Hotel Shop in Germany, completes our MarTech offering, as we are able to offer an end-to-end platform for digital customer acquisition. We can now enable our hotel customers to maximize the ad dollars ROI through a combination of data analytics, AI, connectivity, all powered by Rategain. We are now taking this offering to Rategain customers and have a huge opportunity to sell within our customer base. In our DaaS business, our traditional BI business is now our biggest business, backed by the need of businesses to consume more intelligence as travel rebounds across our key markets. The second reason why we are witnessing growth in volumes, as we predict that with international travel opening up, we'll continue to see travel behaviors which are unlike 2019, and people will not look to travel only during a specific season, and therefore the industry would need to continuously monitor changing demand patterns. This is reflected in the increase of our subscriptions across all our BI products, where we see 120 to 160% growth in volumes. Some segments in DaaS are now above pre-COVID levels. In each of our segments, hotels, cars, airlines, OTAs, we're using a combination of new products like Demand AI, Ref AI as our 10x differentiators. And also on our GTM approach is looking at new partnerships to enable gaining larger market share. Our innovations in Demand AI and Rev AI are being well received and are enabling us to move up the value chain to provide an end-to-end pricing platform to our customers. We're specifically focusing on certain customer segments to enable a laser-sharp focus from a go-to-market perspective. It's yielding results, as in our Rev AI product, we have already onboarded one of the largest franchisees in the United States, which is the Buzzard Rent-A-Car from Las Vegas. We continue to see a lot of excitement by a number of car franchisees for our Rev AI product, and really it's now on to us to deliver onto the client expectations, as when I think about product market fit, we've nailed it. In our distribution business had transaction levels dropped to about 55% because of Omicron in compared to the pre-pandemic levels, although it had reached prior to Omicron up to 65%, which means that the volume growth as things open up should come. Our gross margin in this business continue to improve and are at 92%. Our strength in the business continues to be our portfolio of large hotel chains and extensive network of both global and regional demand partners. We're continuing to focus on connecting new demand partners to all our large chains that are connected to us in the United States and Europe. There are also new cases that we have identified that are helping us differentiate this business and displace our existing competition, making us bullish on this business unit. As a result, we ended up signing some large deals in this last quarter, where we are connecting a large US-based chain to a big OTA. We've also achieved premier connectivity status with Expedia and Booking. Our new platform, another AI-enabled system, which is called Content AI, enables content management, distribution, and an augmentation platform, is again seeing a lot of traction with these big chains and helping act as a 10x differentiator to win clients in this segment. So let me also reflect on our revenue model again. We're getting 75% of our revenue through subscription, and the remaining 25% is transactional revenue. While we saw softening in the last 2 weeks of December and a little bit of January due to Omicron, the dip really only lasted for a bit of December and January, and we see things have started to move up again. The launch of the 3 new products that I've talked about in the IPO roadshow has really been unprecedented for Rategain in terms of innovation in 2021, and gives us great confidence, given the market reception that we had for these products, that we have truly become the innovative leader in the industry. We would continue to invest in solving new needs of the industry through our solutions to help our customers engage better with guests and also lead to wallet share expansion. I would love to share those details with you around these exciting new developments that are going on in the upcoming quarters as they brew for now. In the next few quarters, we are looking to sustain growth through the following initiatives. We are really ramping up our investments in sales and marketing in MarTech, given the excellent sales trajectory that we see, as well as our Rev AI platform. As I mentioned, that we've seen a product market fit and great reception by car rental franchisees. And also, when I talk about our new booking numbers, US, started to really do well a couple of quarters ago, but Asia and Europe, continued to be in loud lockdown. But what we are seeing now is, things are really opening up in Asia and Europe as well. And just to capture that additional demand, we have really expanded our sales and marketing infrastructure in these regions as well, and looking to gain a larger market share. It's also a great opportunity for us to cross-sell our newly acquired product suite from My Hotel Shop to the mid-market customers in our MarTech business. Now, coming to the most important asset of the company, which are our employees. We added about 182 employees at the end of quarter 3, and 50% of all the people that joined were women. Since we are actively promoting gender diversity in the company and intend to overall improve the representation of women in the company. We're now a total of 630 employees across all our business units. Even though our total number of employees have increased as compared to the last fiscal, our revenue per employee contribution has improved by 17% year on year. As an organization, we continue to invest in our employees to help them grow and do meaningful work in the industry. Our continuous efforts to proactively address employee concerns saw our employee NPS improve year on year by over 60% from 19 to 33, a validation of the several steps we have taken to engage, nurture, and retain them. At Rategain, I've always said that we have a strong belief of developing talent in-house and providing them new opportunities. To put this belief into action, we launched 2 key initiatives that are focused on upskilling as well as cross-skilling our existing employees. We introduced an internal product management school in collaboration with University of Maryland, which through virtual classroom training lessons will train existing employees who are willing to and suitable for moving into product management. This initiative is aimed at giving internal employees who have deep industry knowledge get the right skills to apply in building the right products for the industry. I would now like to ask our CFO, Tanmay Das, to take through the performance for the quarter and the 9 months ending 31st December 2021 and give you the post-IPO updates.
Thank you, Bhanu, and a very warm welcome to everyone on this call. It has been a remarkable quarter and one of the best for the company in terms of new sales. The top line of the company is gradually returning to its pre-COVID levels. Based on Q3 run rate, we are almost at par with FY20 annual revenue. Rategain has always been done in a very fiscally responsible manner, with a very balanced approach of maintaining a benchmark profitability level while pursuing growth aggressively. In terms of SaaS metrics, we have followed and comfortably beaten the rule of 40 in most periods. Rule of 40 is the aggregation of EBITDA percentage and growth percentage. Talking about the financial highlights of the quarter ended 31st December 2021, our top line registered a growth of 57.4% year over year. Our adjusted EBITDA margin achieved was 10.7% as against 5.7% in the same quarter in previous fiscal, indicating margin expansion due to growth. The growth was aided by 215% growth in new contracts wins compared to the same quarter in the previous fiscal, and some large contracts signed in each of our businesses. On similar lines, the revenue for 9 months ended 31st December 2021 registered a growth of 44% over the same period in the previous year. Adjusted EBITDA margin improved to 9.7% as against 8.2% in the corresponding previous year. Another metric that we track is revenue per employee, as Bhanu said. It saw a 17% increase from last year, and it stood at rupees 6.91 million per employee. We registered a small PAT profit in Q3 FY22 after a few years. This is on account of, again, margin expansion due to growth. As we have a high gross margin, majority of our growth flows down to bottom line. Further, as we repaid our loan, we will observe minimal finance cost in future, which should help us being PAT positive going forward. Our adjusted PAT stood at 6.3%, which is basically PAT plus amortization of our acquisition costs. We have been utilizing the proceeds for its earmarked purposes. We repaid our loan to Silicon Valley Bank worth rupees 900 million with the cash that has flowed in and an optimally run operation at the company, while with positive cash flows from operations even during the slowdowns, and with a net cash and cash equivalent level of rupees 4,200 million, we have a very strong liquidity position. In 9 months FY22, we generated 178 million rupees of cash from operations as against 107 million rupees in corresponding previous period. Our revenue model remains highly predictable, scalable, recurring, and resilient. The gross revenue retention is at 92%, while the net revenue retention stands at impressive 120%, indicating lower churn and expansion of our existing relationships. The recurring revenue across all our businesses ranged from 97 to 99%. 75% of our revenue came from subscription revenue. Leisure travel contributed 95%. This is changing the change landscape that Bhanu referred to. US remained our largest market with 64% revenue contribution and followed by Europe at 21%. Another metric that we're still extremely proud about is the LTV to CAC ratio, which stands at 11.3, which is far better than the benchmark of SaaS companies at 3. With this, I would like to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead.
Yeah, hi sir, and thank you for a detailed presentation. So now my first basic question is, as in the presentation and earlier in RHP also you mentioned about the geographical mix of a revenue. So example, 65% of your revenue comes from North America. So is it on the segregation of the client base, the clients are sitting there, or is it they are doing a business reason? So if suppose you have some OTA client doing business in the India, but they are based out of North America, so you book it as a North America business, or how is it?
Yeah, that's right. It's more where the revenue is coming from. So if I have a central contract with a customer of a car rental company in US, then I'll consider it as a North America operation, irrespective of where the cars are. Or similarly, if a hotel, if I have a central contract with, say, a large hotel chain based out of US, and they are paying us, so I'll consider it as a North America operation.
Okay.
And the US has all the big companies or big hotel chains, and our ticket size with them is larger. That's why the percentage for North America is higher.
Right. Second question on the as you had also mentioned about the revenue per employee, the metrics you track, and also you had added 180 plus employees this quarter. So is it on the sequential basis there is a significant down for revenue per employee, and if it is, why it is so?
So we increased the revenue per employee metrics by 17% as compared to last year. So there has been a gradual increase on that. The addition also was propelled by the fact that we acquired MHS in October, and which added around 60 more people. So organically we added around 110 people and 60 through the MHS acquisition. I hope I answered your questions.
So, just wanted to, the acquisition has led to this reduction. That's because sequential basis I'm seeing a reduction in that. So, or is it, expected to improve with the Because the sequential there is a dip from a 0.8 crore to 0.69 crore. So that's why, what is the reason for that?
Sequential basis, you were talking about last quarter.
Yeah, Q2 FY22, and if I just considering 180, I added last quarter, your revenue per employee were around 0.87 crore versus this time is a 0.6 crore.
No, so the 180 is I would say this is a gross addition in terms of how many employees we hired in last quarter or so, right? So there is obviously attrition, but sequentially as well as last year, we have been improving this metrics. It's not a reduction.
Okay, got it, sir. And the second, next question is about the IPO proceed. You had a mention about 94 crore related to general corporate purpose. So what is that? And this number is quite higher. So what is that for?
So, in all IPO proceeds, 25% is earmarked for general corporate purposes. So, company can utilize that money in any manner that they want to in terms of whether it's organic growth or inorganic growth. So, that's 25% earmarked in all IPOs, basically.
Thank you, sir. Yeah. 5 minutes.
Thank you. The next question is from the line of Sanjay Avadramani from Envision Capital. Please go ahead.
Yeah, good afternoon, and thank you for taking my question. So my question was on the current attrition rate in Q3, and the second part is on the margins. I mean, what are the sustainable margins we can expect in the future?
So you're talking about attrition rates in terms of customers, right?
No, sir, in terms of employees.
Okay. So currently, obviously, the tech market is pretty hot at this point of time. So we are seeing similar attrition rates that other tech companies are also seeing, around 20% plus. And in terms of margins, look, we are currently the adjusted EBITDA is around 10% at this point of time. And as we grow further, see next 2 to 3 years, there will be gradual improvement to the EBITDA margins because we have a very high gross margin business. So majority of our growth will flow down to bottom line, and that's how the gradual increase will happen to the EBITDA margins. But I think, look, we as I said, we follow a rule of 40, where we are aggressively investing for growth, but we will be maintaining a certain benchmark level of profitability as well.
Okay, so this rule of 40 is like you're planning for revenue to grow by 40%, EBITDA by 40, and net profit by 40. Is this my understanding correct, sir?
No, the rule of 40 is the aggregation of percentage of EBITDA plus percentage of growth. So if your growth is 30% and your EBITDA margins are 15%, then you beat the rule of 40. So rule of 40 is a SaaS benchmark which many SaaS companies follow.
Okay, sir. This is clear, sir. Thank you so much. And any future plans for CAPEX, sir? And if you can highlight some numbers on that CAPEX part.
We are not, DaaS and MarTech business is very asset-light business because everything is hosted and not a lot of infrastructure cost is required. In our distribution business, if you see our IPO process, we have a data center, state-of-the-art data center in Dallas, and we raised around 30 crore to refurbish that data center, but we're still evaluating that. The money, we have not utilized anything, but we're still evaluating how do we proceed on that. But other than that, we are pretty much a very asset-light company.
Okay. And sir, the last question from my end, if you can give us some guidance on revenue for FY23, this will be great, sir.
So currently, this is our first earnings call. Our all efforts are to have a great Q4. We are currently also kicked off our budgeting process, and I think we will be able to give you a much better guidance in our annual call in next quarter.
Okay, sir. I think this is all from me, and thank you so much and good luck.
Thank you.
Thank you. The next question is from the line of Ranil Shah from Hinglaj Capital. Please go ahead.
Good afternoon. Thank you for the detailed explanation. I have a couple of questions. The first one is compared to FY20 in the DAS, I think the revenue was about 125 crores, and in the 9 months in this FY22, it's about 76 crores. And I think about 98% of that is subscription-based, recurring. So, and we've added a lot of new clients since then till now. So, what has been the reason that we still have crossed the FY20 revenue in terms of that? And is it because that we have decreased any pricing for the existing clients?
So, you're talking about the annual, the 9 months revenue for FY20, right?
The full year is about 125 crores in FY20, and the 9 months of this current year, FY22, is about 76 crores. So I think even if we take the next quarter and consider about 40 crores, which we did this quarter, it should still lag behind FY20, in spite of adding a lot of new clients across all three of our.
That's right. Understood. Great. Look, DAS constitutes of multiple, business lines in terms of like we have got OTAs, car rentals, airlines, and hotels. All constitutes DAS segment, and each segment has its own story. And obviously, yes, during the pandemic, we had to give, discounts as well as waivers, etc., which are slowly now coming up because we're now revising contracts and increasing our prices to go back to the pre-COVID levels. So that's why there is a little bit of lag. But if you talk about OTA business, it's already at a pre-COVID, more than the pre-COVID levels at this point of time. Car rentals is where we have given certain discounts and all, which is now coming back, but it is taking a little bit more time. And that's why the levels are low. But if you see Q3 run rate basis, we will be at par with the pre-COVID levels. So this is 9 months contract, 9 months numbers. So if you see Q3 run rate basis, we will be at par with FY20 levels.
Right, and going forward, the pricing should normalize when the waivers should go back. So it should probably outperform in the next quarter. Comparison to FY20? That
should be the right thing, yeah.
Perfect.
So most of the contracts are now, back to the pre-COVID terms, bearing one or two where we are negotiating at this point of time. But yes.
Perfect, thanks. So I had another question. What would be the net annual contract value of the clients that you added in this quarter? So I think we added clients in all three of our segments. So like, what will be the annual contract value for this client?
For this quarter, it was in the range of closer to $4.9 million, which is in terms of Indian rupees probably around 40 crore, which is the annual contract value of those contracts that was won.
Okay, great. So I think that's it from my side. Thank you so much.
Thank you. The next question is from the line of Karthikeyan VK from Suyash Advisors. Please go ahead.
Yes, thanks for the opportunity and welcome to the public markets. One question relates to what was asked just before me. So can you take us through the pricing trends that one should assume, and also some perspective on the customer mix between distribution and DAS? That split you don't give. So can you give us the numbers there also?
We're talking about how many. You're talking about how many DaaS customers use distribution, something like that, right?
Exactly.
Yeah. So it's around, it's same for DaaS and distribution, like 25% of DaaS customers currently use distribution, around similar 25-26% distribution customers currently use DaaS. And this is this is one of our growth levers as well, because there is almost a distribution business, the major distribution business, Disco, was acquired just 2 years back, 3 years back. So we have got almost 70-75% cross-sell opportunities that can be grabbed. And this is one of the reasons why the growth prospects for distribution as well as DaaS we're looking for. So what was the first question?
So what I meant was, you reported 2264 clients for your business at the end of Q3, of which 373 you identified as MarTech customers, and then excluding cross-selling for the moment. So can you give the split of customers for DaaS and distribution separately?
Yeah, there will be overlaps, obviously, right?
Sure.
Yeah, there will be overlaps, and yeah. So 373 is BCV, but again, there is MHS as well, which we added around 600 more, and rest are DaaS and distribution.
MHS is 600, is it?
Yeah.
Right. And in terms of pricing, you had mentioned in interviews earlier that while one of the segments is at $90,000, one is at 69, and MarTech is at 27. How to think about pricing trends in these segments? You obviously talked about the reasons for the churn also. So if you have to give us a structural perspective on what to think about in terms of pricing in these segments?
I think the distribution segment, where we experience a lot of pricing leverage that we can implement, because it's a production software. So without it, the hotels cannot really book those reservations. So we increase the prices every year on a CPI increase basis, right? So we enjoy a lot of leverage there. Next is DaaS, where the data that we provide is so core to the business of OTAs and car rental companies and hotels, that they cannot live without their data. So there as well, we also obviously had to give discounts and waivers during pandemic time, but now most of the contracts now are back to the pre-pandemic levels, and we will continue to apply CPI wherever we can in this segment. BCV is more, comes out of the digital marketing budget, but ironically there is no scale competitors for us, so we don't have a lot of pricing pressure in BCV as well. So yeah.
So yeah, okay, fair. Let me not belabor that. Thank you very much, and I'll get back in the queue. Thank you.
Thank you. The next question is from the line of Ranjit Gopal KA from HSBC Asset Management. Please go ahead.
Yeah, thanks for the opportunity. So I had two questions. First one is on the organic growth trends for this quarter. So basically around 23.6 crore came in via the acquisition of My Hotel Shop. So what, I mean, although that I think was more for 4 months, the integration was for 4 months. So can you give the color on the organic growth for this quarter, both in terms of YOY as well as on a quarter-on-quarter basis? That will be helpful.
So the 9 months ended FY22, you saw organic growth of 31% and 13% of inorganic growth. And for the quarter ended, it was 35% organic growth and 22% inorganic growth.
Okay, got it. That's very clear. Thank you for that. And in terms of the number of customers added, also there would be a component of the acquisition coming through, right, in terms of the number of customers that we have added this quarter. And so what has been the organic addition and one coming through the acquisition?
So we added total 778 customers in this quarter. Out of that, around 600 was through NHS acquisition. And that's a great opportunity for us to cross-sell our existing product to those 600 customers.
Sure. And you also mentioned that the revenues from this acquisition has been accounted for in MarTech. So, but there is also a distribution element also in the acquisition. So, everything has been accounted as part of the MarTech revenues in terms of the segmental apportioning.
Yeah, at this point of time, it's clubbed in the MarTech business. It's more compatible with MarTech business than the distribution business.
All right. And the second question is on the profitability front. So obviously we are seeing some bit of an improvement in the EBITDA margin trajectory. But I wanted to understand from an amortization cost point of view, because you gave the number, the bottom line number, both pre and post amortization. So on a post amortization basis, are we basically looking at an improvement in the PAT number going forward also, because that is something which has been impacting our bottom line in the past. So now will the growth in amortization cost will be much lower than the growth in PBT that we are going to see?
Yeah, that's true. Look, amortization currently is a fixed number. So as your revenue grows and your percentage of EBITDA in absolute terms, your profit before amortization grows, and this is bound to improve the PAT level. So that's why if you see, the FY9, the 9 months ended is almost, maybe 1 crore loss, right? And as against a large loss that we had last year. So as we grow, it's a function of growth as well as EBITDA margins, and accordingly the PAT will be positive based upon that.
Okay, and this includes any acquisition related impact as well, right? So this includes everything, all kinds of amortization costs.
Yeah. So what we have done is that we have just taken out amortization on all the acquisitions currently we are incurring. So it includes all Disco, BCV, and MHS, all 3 acquisitions that we have done till now.
Okay, and what will be that percentage of revenue number right now?
So currently it's around 4%. Yeah.
Sure. So we expect in an absolute term this number to remain where it is, and if there is obviously a revenue growth coming through, then we will see much larger kind of a profit conversion.
Absolutely.
Okay. That is very clear. And just if I can squeeze in one last question on the demand environment post the current wave. So how are we seeing the initial trends in terms of opening up of the travel industry, especially in the US, and also in the context that some bit of a fiscal stimulus will also be withdrawn. So how are we seeing the trends from a US market point of view, and also to some extent Europe? So how are we seeing the initial trends post the current wave?
Yeah. Bhanu, Ankit, do you want to take that?
Yeah, I'll take that. So, as I sort of mentioned in my opening remarks as well, we are seeing a structural shift happening in our industry in terms of, the acceleration of digitalization into, there are, acute labor shortages, especially when it comes to the US. So we are seeing faster adoption of technology, and that's why I mentioned that we are, looking to sort of accelerate our sales and marketing investments so that we can capture the additional demand that comes as a result of these structural shifts that we are seeing in our industry. So we are actually in an investment mode, and we do see, sales activity to pick up. What's also heartening to see is that, in terms of the overall lockdown restrictions going away, especially in Europe, so while our numbers look good, most of the contribution was from the US. And now that things are opening up in Europe and Asia, we've really expanded our sales teams in Europe as well to capture that additional demand. So we are seeing, when I look at our sort of what is your leading indicator is sort of your pipeline generation. So we continue to see, significant pipelines being created in these regions. And the fact that now we have this one platform, it's becoming extremely compelling. And, one of the things I indicated also in my comments is that we're the only company that sort of doubled down on innovation and launched all these new products like Rev AI, Demand AI, and Content AI. And we are seeing, great reception on these products. So as demand sort of comes back, the overall, travel demand and, our customers open up their purse strings, we are quite hopeful that we'd be good beneficiaries of, the fact that we were able to launch, products that were the need of the hour.
And I'll just give some more detail on the demand question that you specifically had, just to give more context on what Bhanu was saying. So we did this analysis around a week back, 2 weeks back, using our Demand AI product, which even you can sign up and look at demand for almost 60 cities. And we saw that for cities like Barcelona and Las Vegas, as well as New York, demand had already started going up in a range of around 10 to 14% as per the data that we were processing by the end of January and first week of February, right? Which means, and this is a trend that we saw in almost all cities, including in India, where Omicron actually came on much later. And what we've concluded that is that the overall impact of the wave was just for 2 weeks. Or two weeks is when it kind of went down, and then bookings started picking up, and resultantly demand started picking up as we are seeing across major cities in the US and Europe. And we only feel that as we get to spring, this will only build up further. Because now people are out of this wave, they will start planning vacations. So in March, April, obviously we will see much bigger surges in demand, just the way we saw it last year in the US. So I think that should give you more clarity on how demand will recover.
Sure. That's very helpful. Thank you very much. And in the mix of revenues, currently we've transformed from, I think, a larger proportion coming in from more than half a proportion coming from distribution, now to 40% distribution and less than a third each from DaaS and MarTech. So is this a mix which will remain at least in the medium term, or would we think that the distribution platform will grow much lower compared to the other two segments, and hence the mix can move more in the direction of MarTech and DaaS going forward?
I think the direction will move more towards MarTech, because we are seeing a lot of traction in the MarTech business, and there is a huge TAM that we are going after and investing. As Bhanu talked about, that we have kind of started investing a lot in the sales and marketing of MarTech business, because we clearly see the opportunity. So it will more tilt towards MarTech than other two businesses.
Okay. Thanks a lot, and wish you all the very best.
Thank you.
Thank you. Ladies and gentlemen, we would request you to please limit your questions to 2 at a time. The next question is from the line of Ankit Kanodia from SmartSync Services. Please go ahead.
Thank you. So, just wanted to understand your strategy as I look at your presentation and see the customers' data. As in, you have put down name of your marquee customers. As I understand, you're predominantly in US and Europe. What is your strategy for the upcoming markets in Asia, specifically India? And how are you positioned there? What do you see as a market in India? Hello.
Yeah, so when we talk about our customers, 80% of our revenue mix is through hotels, and we focus largely on the mid-market and enterprise segment. So just to give you sort of lay of the land, there are about 1 million hotels out there, and the ones that are organized as part of a hotel chain or some sort of a management group is about 300,000. So we call these, this constituency is about 1,400, potential prospects. And when we look at the distribution of these prospects, they're largely in US and Europe. So I think somebody else also pointed out, so while the headquarters might be in the US, they might have operations in India or Southeast Asia, but the decision making for the most part happens centrally through the headquarters, which is either based in Europe or US. So in terms of our focus, I think we'll continue to be focused on these key markets of US and Europe because, as I mentioned, the mid-market and enterprise customers' decision-making sits out of these regions. We do see in terms of new hotel development, a larger portion is actually happening now in Asia. So we will see acceleration. But if I had to give you a sense on, what will be the revenue mix geographically in the near to midterm, I don't see it changing. It will continue to be the way it is.
So is it fair to assume that the way we are positioned in our business, something like a Club Mahindra or a Sterling would be too small a customer for us, given the way we are positioned with our US and Europe customers?
Yeah, I think that's fair. When we look at, the solutions that we have, it is largely targeted to, sort of the mid-tier, mid-scale, or I would say upper luxury, especially when it comes to our MarTech business line. We do, however, operate with, budget hotels. Like, for instance, Oyo is, one of our largest customers, and we, as you know, they have a lot of international footprint. So we are the ones who do provide connectivity for all their international hotels across all the international OTAs. So, so our sweet spot continues to be more sort of the mid-scale to upper luxury. And if you look at even the, overall ticket size, the potential to gain a much larger wallet share resides with that, given the higher budgets that they have per unit basis.
Thank you. I would request Mr. Kanodia to rejoin the queue for follow-up questions. The next question is from the line of Pritesh Vora from Mission Holdings. Please go ahead.
Hello, can you hear me?
Yes, sir.
Hello? Yeah, can you hear me, sir?
Yeah, we can. Yeah, we can hear you.
So, can we have breakup of your revenue based on the three businesses which you are undertaken? I mean, approximate what kind of breakup we can assume? Also, the sector-wise, where do you see the larger growth coming up? Is it your DaaS business or MarTech or distribution? Where do you see going forward the organic revenue-wise? Where do you see the most growth coming from?
Bhanu, do you want to take that or should I?
Go ahead.
Sure, thanks. So, we obviously look at our MarTech business as the biggest growth driver because currently there is around 900,000 hotels that we can sell this solution to. And we currently have only close to 400 hotels using this solution. So there is a huge addressable market to cater to. Our immediate goal is to reach to 1,000 hotel to sell to. And then obviously this business has got very low competitive intensiveness. And how we are seeing the traction in my last 9 months, we have increased our number of properties by 65%. So, and the last quarter has been a stellar quarter in terms of new sales for this business. So, this business is where the majority of growth will come in the business. In terms of distribution of revenue by these three segments, obviously in the 9 months ended, we had a large portion, like 40% came from distribution, 30 each from DAS and MarTech. In Q3, DAS and MarTech contributed more, but distribution contributed lesser because of the Omicron impact. But I think going forward, if you want us to pin down which segment, I think the MarTech segment will be the largest segment, say 1 year down the line, because the growth that we are currently seeing.
Right. And where do you see the margin, most margin will come from? Which business? I mean, distribution, I'm sure it will be a steady business where you may not be doing much. But where do you see the margin improvement will come from?
So look, margin improvement will have, with scale, it will automatically have. But currently, DAS is our most profitable business unit, followed by distribution. And MarTech is still in a growth investment mode. That's why the margins are lower there. But with the growth, all three businesses will see margin improvements. Because in all three businesses, the gross margins are higher as compared to, say, a services company.
Okay. And can you bifurcate your revenue on subscription base vis-a-vis actual usage based? So what I'm trying to understand is how much of the revenue will pick up based on the travel sector opening vis-a-vis they are providing just a subscription revenue where you don't get benefited by number of bookings, or I mean to say the hotel number of booking increases. What is the percentage of revenue coming from these two segments?
So currently, look, about 25% of revenue comes from a transaction-based revenue model, where especially in our distribution disco business, where we take a cut from each booking that a OTA provides to the hotel. So with natural, the bookings or the demand coming back, we'll see an increase in this 25% of our business. 75% is subscription in nature, but out of that, 32% is in a hybrid model. So 32 hybrid model in the sense that we have a minimum subscription, but we also charge for excess usage. So there also we'll see that though the minimum subscription money is safe, but once the volumes increase in terms of demand for data and all, there we'll also see uptake as well.
Thank you. I would request Mr. Vora to rejoin the queue. The next question is from the line of Nikhil Chandak from JM Financial Family Office. Please go ahead.
Yeah, I had only one question. So, when I see the presentation, etc., I figure the EBITDA margins are in the range of 9%, 9%, and PAT margin in the range of 5-6%. So, from a longer term perspective, what would be your target EBITDA margin? I understand there is a lot of investment which happens in sales and marketing, but should one assume these are the sustainable margins, or is there a significant scope of improvement from where this number is?
So, let me take that, Anay. So in terms of, how we think about growth versus profitability, clearly as we've noted, we see, opening up of this sector. We've sort of got a number of new products that we built over the last year. And just the whole trend suggests to us that there is a huge opportunity for us to grow. So what we use as a guiding principle within Rategain is, look, we need to, which is what a lot of SaaS investors look at, which is the rule of 40, which is an aggregate of your growth percent and EBITDA percent. So, we see that there is a huge opportunity to grow, and that's why we'll continue to ramp up our sales and marketing infrastructure, which is what I talked about. We're doing that in the US and Europe. And in the near term to midterm, yes, we will continue to see similar margins. And as we continue to get scale, I do see marginal improvement in margins every quarter. but the focus will continue to be, let's be in this 10 to 12% range, and if we see opportunity to reinvest and grow, let's just continue to do that. And that's how I see it, definitely for the next few quarters. And as we our goal is to hit, in terms of revenue, the 100 million. As we get to that number, I do see the scale will flow down directly to our EBITDA, and the margins will expand quite significantly. So net, near to midterm, similar margins improving marginally every quarter, and then mid to long term, we can be between 20 to 25%.
Okay, great. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I now hand the conference over to Mr. Bhanu Chopra for closing comments. Mr. Chopra, you may go ahead, sir, with your closing comments.
Yeah, so thank you, everyone. I hope we've been able to give you a good overview about our company and insight into the performance thus far and the growth story that lies ahead. Moreover, I hope we've answered all your questions appropriately. However, should you need any further clarifications or would you like to know more about the company, please feel free to contact our team or SGA, our investor relations advisors. And thank you, everyone, for being on the call today.
Thank you. On behalf of Rategain Travel Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.